Great gold move so far this week, this month, this year, and
Yeah.
last year. Starting to become a bit of a trend, isn't it? A bit of
Right?
stirring silver. Platinum is coiling up. So everything in terms of our positioning is serving us royally so far. So maybe I'll steal a bit of your thunder, but that's certainly looking pretty good and keeping our tails in the air.
Let's talk about it. Let's start with gold here. It's just since I've had you on, what a run, and it's still running. So let's talk about what you see going on and where you see things going.
Well, it's fascinating. I'll talk actually fundamentally before we get technical, because different people like the idea of technical, but everybody likes the story, and that's the fundamentals. And the key thing that's changed since we last spoke, which was quite a while ago, as you referenced, is we were talking prior to the election and the election outcome, and we were all in that space where Janet Yellen was spending like a drunken sailor. The Biden people had actually denied a recession on the basis of employment when they had been one of the largest employers of statist non-jobs. So a lot of the sort of cultural Marxist type jobs were being created, fluffy positions, and government positions were being, there was crowding out by the grand communism. In other words, being employed by government was the thing. And they denied the recession on account of this unemployment number still good when they were behind it. So they were throwing money into the fire to keep heat in the house, even though the roof was gone. They kept shoveling it on, and they kept denying. And then it was kind of like Louis the 15th with Yellen, after me the storm. She said, you're going to hit emergency measures now. Good luck. Poison chalice, handover. So I get the feeling they never thought that they were going to be carrying on, that the administration change was pretty much fait accompli, and they were quite happy to leave quite a mess. This is the level of, I don't know, the political discourse, the controlled demolition, as I've regularly referred to it. If you think these people are doing what's best for the economy, then you only have to look at the last two administrations to see exactly how that went. The events of CV19 broke the funding mechanism. So this is the second part of the answer to this question, which is, what do you see and how's it all about gold? We have to understand what's driving gold. There isn't a dollar on its own. There's a UST, a treasury, USD. We need to think of it as, two components. There's the debt and then there's the credit. And fiat is a derivative proxy, and it's borrowed into existence. So when the USTs as a funding instrument crash and the rates spike, it gets real expensive for government. And that's what you've had. Now, with that Yellen narrative, she also shortened the duration immensely on the debt, so that you now have 9 trillion in this year alone that needs rolling, which is an unbelievable amount of debt. It's never been anywhere close to as huge. It is literally a landmine laid of intent, because she could have put it out on 30-year, 10-year, but she shortened the duration, so that essentially there was an explosion for 2025. This is why I say this is very much planned. And I'd imagine that in spite of a weak economy getting weaker, and we met the criteria of recession, we just never admitted it, we are actually going to roll into a deeper contagion, and actually cuts and all these things are too little too late, and they're going to accelerate the doom loop of that. So as you start unwinding all the status non-jobs, flushing out the corruption, there was still money and liquidity that was in the system. You're taking liquidity out, you're making them ward of state welfare, probably. A lot of them won't be immediately employable. They're going to have to sell their homes. So you've seen in Washington a 21% drop in average asking price. You've got twice the amount on sales. So that specific to government. Also in government, you've seen the effect on airlines. There's been a 50% reduction in flying of statist employees. And this has led to a 21% guidance in reduction of revenue. That's leading to a 50% reduction in earnings per share. And it's not just Delta, it's American, it's all the major airlines. So you're already seeing the contagion of contraction, how it works. Everything is related. Everybody tends to think in silos. No, there aren't. There's pipes and feelers and veins running. We're in one big system, and you don't cut the arm off and expect the guy to be fine. And he grows another arm. It's part of the body. It's part of the system. He has stress. He bleeds. All the things that go on. The heart rate goes up. Everything happens. So this is a feedback system, and we're now in the acknowledgement that the debt that lost the better part of 50%, round about 45 at current moments. Everybody is now in that trade. You had Druckenmiller and Paul Tudor Jones. Again, after we met each other, they came out and declared that they are short on the debt markets. And this has led to everybody else following them and crowding out. So these people are late. So what tends to happen is we're now going to get a recession. And in actual fact, a little bit of blowback from a hyper overvalued stock market is actually going to run back into the bond market. Not like before, like they were just two options. The third option has emerged, and that, of course, is gold, because you asked the question about gold, and I'm eventually bringing you back to why I took you on that long walk. And it is that, in fact, the beginning of the failure of the reserve asset that was pitched to you as a reserve asset and to the Saudis in the petrodollar is debt. And when the debt rates go up, as we've recently had, the climb, the valuation collapsed. Now everybody is irresponsibly short on the debt markets. They're a bit late. You're going to get a little bit more likelihood that the debt rates are going to get a bit of a bid because the stock market is being sold off and some of that liquidity is going to go in there. But some people in the stock market are going to go, miners look cheap, gold is on a tear, and you're going to start to see the money going into those equities. And can I point out, many of the miners suffered from lack of attention on account of being too small a market cap. So can you imagine if you start to get real significant holdings in miners? That's going to be absolutely huge. And there's only two release valves for this. It's the debt devaluation that you've already had so far. Too much has happened. It needs to stop because you're going to make it almost untouchable. So we might get a little bit of currency period in here where the dollar doesn't do so great against the euro. We're going to hear the Fed talk today, but in actual fact, I'm seeing certain nations look even weaker. So we're not saying the dollar is going to be super weak, but I think relative to its main trading partners, it might have a spell of weakness. So that's also helping the gold price, because essentially it's the anti-fiat. Gold is the king.
Yeah.
It's the original. And the dollar is the big boy of the derivative money, which is currency, and gold is the real money. So that's why, without even showing you a gold chart, all said, we should do that. Otherwise, we're being really remiss. That's why we are so excited about what's happening in gold. That's the silver. Let's get the gold in there. And that's what you see.
Point out something interesting. My portfolio manager just the other day, he has said he has never seen this in his career. The general stock market, the S&P is down, 4% this year in gold. My portfolio is up significantly. And it's all gold and gold stocks, and I should say natural resource related. So there's a huge dichotomy, and I didn't know if I even expected such a dichotomy yet, if that makes sense.
Absolutely. Well, you've had a sector. What you've got to remember is you've had a sector that's been completely ignored and actually dissed and undermined and had the downside of the inflation trade without any of the upside. So the costs of energy, we had oil go up to $130. You had labor costs going up because of inflation and living standards. And you actually had a 3-year sideways move in gold post its high. Here's that 3-year sideways move. So we're playing with the gold chart a little bit finally. And every time you were being tapped out at the 2K, and we said once, twice, 3 times, and then you're breaking. And that's when you broke and you sat on it and you wound up. That, what we call an HVF method setup, has delivered to this level a 1:38 trade. So if you risked 1,000, you got 38,000. If you risked 100,000, you got, you can do the math, 3.8 million for that trade. And you are marching on now it's not a short, you did get a small pullback here. That's why it's a target, but it's marching on. It's showing real robust strength. So, as long as the reserve asset of debt is no longer viewed in the same light, whilst it might get some flows if they kill the stock market and allow the recession, it's never going to be viewed in the same light again. That's because it changed. And what chart I did show you, that I know I showed you for people that watched the previous time we chatted, it was 100% this chart, the US 10-year, about why we argued where were all the macro technical guys, because this was the US 10-year, and you finish a bear market on yields with a final capitulation. This is log scale, by the way. It's quite important to use log scale on very big time frames. And
Wow.
when you're doing multi-decade, and this highlights the absolute extremity of the move.
Yes.
Like that. This was a final spill. And of course, in valuations, it was a blow off top, like the
Mhm.
NASDAQ. But there were quite a few people calling, wow, this is ridiculous on the NASDAQ. In the bond markets, there were no macro technical guys. In August of 2020, we called the first setup in a new trend and said you're going to be on higher highs and higher lows in rates. And that means the market is going to be short. And this is, again, not wanting to sound like somebody who's just a broken record. This is your whole theme of reset. The debt fiat funding system turned. The 40-year bull bottomless overdraft that was allowed. Here's the TLT in the values. It's just the plain opposite of the chart I've been showing you. That was a final blow off. People don't realize that the year of 2020 was a pivot. They printed and did absolutely everything. It was like everyone remembers the GFC, the subprime crash, and the dot-com crash. This was so significant. They created such a stop, a cessation in economic activity, that they managed to get the final pump in the debt markets. It's over. The debt markets will never have that set of circumstances again, where everything, no one's spending, all the stock market collapses, every other asset classes collapses, all the liquidity has only one place to run. They can never have it again. That was their final hour, and everything now has been far, far worse. And the amount of times I repeat the saying, I'm even sick of saying it myself, you get the escalator up and the elevator down. That's your elevator so far on the US debt. And that's been your 40-year escalator. So the loss of funding and what's happening with Donald Trump. When we last spoke, it was all still the profligate corruption, proliferation, non-economic sound money expenditure. Now you've got nothing but cutters, because they have to. They've got a 9 trillion roll, and they have to, and they're actually doing it.